Perfect. Thank you. So I mean, I'm not going to do you guys one by one, but I'm lucky today. I'm joined by Ewan from Westmont, that I'm sure you all know very well, Norman from SBM in Mauritius, and Lotfi, who is from EBRD. And it's Lotfi's first... I love it. It's Lotfi's first AHIF. I mean, he's a seasoned vet of conferences, but this is his first AHIF. I thought we'd give him an opportunity to talk a little bit about EBRD. So when we get to his first question, he'll do a little intro about the firm, or the bank, should I say. Great. Well, thank you very much, guys. I think I want to start, we sat down and spoke about this a little bit in advance, the four of us, and we thought it would be best to talk about how you can package a hotel project or development to make it attractive from an investment perspective, i.e. the banks that are sitting here today, or a financing perspective. And I think it would be remiss to start off by talking a little bit about the changes in operating models since the pandemic that were kind of forced on the industry. So to start us off, I'm going to ask Ewan to just talk a little bit about how, if at all, the operating model has changed for you guys as Westmont since or as a result of the pandemic.
Good morning, Mark. Good morning, all. I think it's always good to look forward, and we do that a lot at the forum, Mark, but reality is that reflecting back as well, we can take a lot of learnings about what's happened. The pandemic was incredibly difficult for the industry. It's well documented. Probably the greatest impact was upon hospitality as a commercial industry. And that caused us, as all owners, to really sit down and think the impossible. We challenged our norms, our assumptions were all thrown up. And as Westmont always does, we went back to the data. And we really drilled down on each of our assets, understood the data better, to allow us to make those decisions about what do we stay open, what do we close, how do we manage our cash flows, and where we have investment partners, whether that's other equity or whether that's debt partners, understanding what those expectations were and really ramping up the communication and analysis of what was going on. We couldn't give dependable forecasts, so it really became important to give that running commentary, that context, that understanding. So to your point, yeah, we really did, within a specific hotel unit, challenge ourselves about what's the cost base, what really is essential with regard to delivering the customer promise, whether it's a brand driven or not. Thinking again about HR, how do we get that flexibility in there? So preparing for when the demand comes back, how do you do that? Challenging all our third-party contracts, cash became king, and again reasserting ourselves with regard to the asset. The asset still has to be maintained. How do you do that? And that caused us to look at other real estate classifications and bring in maybe some of those practices which previously we hadn't done for whatever reason. So I think some of the pressure the pandemic put on us, I think ultimately would have made us a better business and better asset managers.
So kind of taking control of what you can control, which is the costs. Yeah, we saw that just as an aside, retail and hospitality, F&B and retail were really the worst hit from the pandemic, but also then the quickest to kind of bounce back once things reopen. So it just kind of highlights that volatility and the importance of kind of managing that cost structure. And then that follows on to my first question for Norman, which is, does that sort of simplified cost structure and the efficiency of the budget hotel make it necessarily more attractive from a financing perspective than a luxury property or a five-star hotel?
So I think it all depends on the market that we operate in. Obviously, in Mauritius, the luxury segment has been the segment that has recovered quickly post-COVID. Like you will see yesterday from Emmanuel, the ADR has ramped up significantly since the last 6 months. I don't know whether it's revenge tourism and everyone's traveling and decides to spend all their money on the luxury brand and the high end. But what we've seen in the market in Mauritius, especially, that the luxury has recovered faster than the retail or mid-market hotels.
It's interesting. I mean, but, and I'm going to ask you a second question on the same thing. But so I guess the answer is depending on the market, right?
Exactly.
Depending on the market, because, and I know Lotfi's nodding there because I'm going to ask you. Well, I'll follow on from that and just sort of say, from your perspective, there is that increased attractiveness from an efficiency perspective. Well, why don't you give us a quick intro into EBRD and then...
Sure. Thank you, Mark. Hi, everyone. So just 2 minutes on EBRD. So EBRD is an international financial institution present in 40 countries, from Morocco to Mongolia and big hospitality countries like Turkey, Egypt, Croatia. We really want to push our investments in these countries given the economic impact, in particular post-COVID. And also because we are big believers of green investments. Just some numbers. We invest roughly 100 billion euros across 40 countries every year, 4 billion of portfolio in real estate and tourism. And in Morocco, we have a current portfolio of 4 billion over the last 10 years. And we hope to do more after this event. So the question about the efficiency on...
budget hotels.
On budget.
Yeah.
I think the good answer is depends on the market, but clearly it's about the diversification of risks. One important element is also the ability to attract the domestic market post-COVID. So maybe on the domestic market, when you look how countries going to really the high end is more complicated to recover. So maybe Mauritius is a bit particular, but probably in Morocco it's good to see that maybe mid-market can be interesting as well.
Yeah, I guess Mauritius doesn't have as big a domestic market. It's mainly international tourists flying in, right? So,
correct.
Yeah, whereas on the continent, we have regional markets and domestic markets for corporates.
For instance, here in Taghazout, the numbers were unbelievable. With COVID, it was really a prime destination for the domestic market. So, depending on different hotels, but clearly it's important.
And that's similar in other parts of the continent as well. And even the corporate travel, the corporate markets were kind of kept alive by domestic corporates rather than international corporates coming in. Would it make a difference, talking about the different segments, moving a little bit? And the obvious answer to this is probably a yes, but I wanted to hear your perspective from a development bank perspective, and then maybe even Norman's. Would it make a difference to have the operators put real skin in the game, not just $1 million here, $1 million there, key money?
Yeah. It's always an interesting topic when we discuss with the investors. And also with big operators, basically the answer. But clearly it can help to mitigate the risk. There is an alignment of interest, and it helps the financier, being debt or equity. Also, I didn't highlight it, but EBRD do everything between debt and equity. And if we are equity investor or debt investor, when we share the risk and our interests align, it's easier to have everybody having skin in the game.
Yeah, I think that's very important to have alignment between the operator and the owner. So having a small skin in the game sometimes help on the banking matrix of how we look at the financing all these hotels on the island.
Do you consider key money skin in the game, or is it's just money that's spent on CapEx?
No, we look at the money spent on CapEx. Sometimes they come in as a 10% shareholders or only the operating CapEx. So we look at both and see how we can mitigate the risk and how that helps on the credit side of it. Yeah.
I know that Ewan has feelings about leases that are mixed. Well, they're very clear from a hotel perspective, but from a non-hotel perspective, from a third-party retail perspective, maybe you can give us a little bit of your view on leases as a kind of debt coverage for the banks, and then maybe how leases can actually help the operator or the owner make their investment a little bit more secure from a bank's perspective, talking about third parties.
I think it's probably one of my kind of personal hobbies is to talk about the real estate market in the continent. And I think one of the disadvantages we have in the continent versus other regions of the world is that our real estate market's not sophisticated. It's got pockets of sophistication, but it's still got lots of opportunity to become more sophisticated and more transactional based. From a Knight Frank perspective, we're aligned, I think, with regard to it would be good to see more commercial real estate transiting through hands. I think when you have the movement with regard to changes in demand in a market, you would naturally expect that assets would move ownership. Doesn't generally happen that often within the hotel segment within the continent, but when I look at other real estate classifications, it's becoming increasingly so. So the retail and what's happened with regard to the commercial office space market, as you know from a Knight Frank perspective, certain markets are pretty dynamic. If we could see more of that in the hotel space, I think that would be advantageous. And what I hear from the banks is, well, hotels don't transact that easily because you don't have these fixed rentals. It's easy to sell an office of a fixed rental, so who's going to buy a hotel that's got all this risk attached to it? And we just don't see that in other markets. I suppose from a Westmont perspective, we can see the global perspective, and if you look at where assets move in hotel terms in other markets, we actually do really well versus other retail or commercial asset types. It's quite often there's a premium. It's an emotional component to buying a hotel asset, as well as looking at the longevity of that asset. Maybe it's a longer hold than some other real estate classifications. So I think what I'm leading to, Mark, is that banks have tended to look at the fact of, well, hotels don't sign leases, so that makes them complicated and difficult. Well, actually, I think if you kind of pull back a little bit and look again and say these are commercial assets, they're cash generative, frequently generating forex earnings, they're high employment with regard to social impact within those areas, as well as the whole purchasing power of a hotel. And then again, we can see it in many, many African cities. These are the assets that go through multiple life cycles. So I would actually argue quite often they're not particularly the most risky asset investment within a city such as Casablanca or Nairobi. I think investing in a hotel is less risky than maybe investing in a standard white box office development.
Yeah, that's really interesting. You actually touched on a whole bunch of really interesting things there. I mean, like you said, the markets are so diverse, but if you're looking at a market like Nairobi, and I'm a little bit biased, but I think it's probably the first truly kind of evolved market outside of South Africa in sub-Sahara. Even 15 years ago, the number of investment-grade assets, be they office, retail, or hotel, there was just very, very few, particularly from an international investor's perspective, that would tick the boxes of scale and build quality and all the rest of it. And those mistakes still happen, and people just building and then coming to us and saying, find us a tenant or find us a hotel operator. But more and more now, people are taking advice early and are building stuff that international funds and international investment companies like yourselves are coming in and saying, well, actually, this is built to best-in-class spec that is comparable to Dubai or Joburg. We can look at buying this. And that the office lease piece is changing, like you said as well. Given what's happened with the pandemic, the whole office market is turning on its head a little bit and trying to reinvent itself. So that might change the perspective of the banks. I'm not really sure. We'll see. But from your perspective as bankers, and I'm going to ask you, Norman, would the more conventional in-the-box way of looking at things, would it be more attractive to have those kind of fixed income elements to a hotel? So, F&B leases, retail leases and stuff.
So what we've seen, like Ewan was saying, the market is getting deeper. For the last 10 years, we've seen owners were wanting to finance their own hotel and try to operate because they believe that they will get different kind of profit from an operator and an owner. But in the last 10 years, we've seen a lot of hotels owners trying to just build and lease, so it's becoming an investment class of its own. You would see 3 hotels have already done that on the island. Lux have sold the property itself and are just managing it. The same thing happening in one of the big 5-star resorts in Seychelles, one more in Senegal. So basically what I'm saying is that the owners are now understanding that it's one thing to own a hotel, but one thing is to operate and manage. So obviously, they are segregating these two components, and that's why we're seeing more leases today. And obviously, as a bank, we prefer to have these two risks on the balance sheet and funding the owners and funding the operator. And that makes more sense as a package itself.
Yeah. So the short answer is yes.
Yes.
Lotfi, is it the same from a development bank perspective?
In a way, it's easier to sell to the investment committee because basically it's risk transfer. Everyone is trying to transfer the risk here because, and in real estate generally you prefer the lease. But I agree with, Ewan perspective from an owner operator as well. So, but the short answer is yes, in a way. Even it's very difficult to find this kind of lease on the market these days.
I mean, as staying with you, EBRD are a development bank, so obviously there is a social ESG element to that forms part of your investments. How important is that really? Well, I'll ask you the follow-on question afterwards. I'll ask you that first. I mean, how important is the ESG piece to your investment decision?
Okay. As you said, we're a development bank, and if we can do everything between equity and debt, with ticket from 5 to 200 million euros as an investment, we're trying to differentiate ourselves on the market. And clearly today, green, it's important. Energy efficiency, water and resource efficiency, blue economy. So insofar that's also, it's profitable for the companies, the hotel and the operators. It's really important to develop green buildings and everything related, and particularly now, these days with the inflation of costs. I think panel was on that as well earlier today. So it's part of our development angle, how to really insist on green investments.
And following on from that, are there specific markets or criteria for markets that you would look at? I mean, are there markets that are too developed, where effectively, I mean, I talk to the IFC all the time, and they're regularly telling me that they don't want to invest in stuff in Nairobi or Kenya because it's already a developed market. So
the second important element in our investment strategy, it's all about inclusiveness and sustainability. When I say inclusiveness, there is economic inclusiveness, trying to develop a new destination, something like Taghazout being a relatively new destination in the country, like resort. Developing also, having backward linkages to the local communities, all about skills, trainings, academy for the local workforce, but also like youth support, but sometimes women in business as well. It's important for us to really develop the various inclusiveness elements. So it's important to think about this in the investment opportunity.
And I mean, how do you view...
Sorry, I forgot one important element, and the one is there actually about urban regeneration. So when we discuss destination, it's really important to try to... location in real estate is really important, and clearly trying to redevelop old areas that have huge potential, and particularly the jobs creation, the local employability, it's really important. And for instance, the Marriott in the previous gold downtown of Casablanca was really an important one.
That was the question I was going to ask you, was how you view redevelopment versus greenfield projects.
Well, one of our investment committee guys say, never finance an hotel in the first or the second time, do it in the third time, you think you're not going to lose money on it. So if you go to regeneration, you reduce your execution risk, all the cost overruns in the beginning. So in a way, it can seem easier to refinance a rebranded, more modern hotels than a greenfield one. With the right sponsor and the right operator, with the proven business model, with the right branding, the right location, it can be an easier sell internally in our investment committees.
I'm wondering, Norman, I'm going to ask you this. Is that a development bank mindset, or from a commercial banking perspective, does it matter whether it's a refurb or a greenfield?
Well, today, funding a greenfield can be quite complicated with the inflation going up. You never know where the costs will be enough to finish that hotel. So obviously, both has their pros and cons, but we will have to look obviously at the sponsors, and so it depends on which greenfield we are going into.
I mean, it's no news to anybody that the basics, the sponsors, the brand,
Exactly.
all that kind of stuff is still very important, but it's been quite interesting to dig into some of the other stuff. And I'm going to ask you, Ewan, about your thoughts on refurb versus greenfield projects. And I know we discussed earlier some of the differences between more developed markets, or the Western markets, if you want to call them that, than the African kind of context.
I think it would be good to see encouragement to do more regeneration and do more refurbishments. Mark, what I mean by that is, if you look at the data is that to take a building that's maybe 30 years in the city and to repurpose that and to make it relevant again, achieving all the brands required with regard to the guest journey, you can do that in such an environmentally more conscientious manner than demolishing it and rebuilding a new structure. And that's a collective cost, if you like, with regard to that carbon impact of demolition and rebuild. So I think to see real estate investors coming in and taking those hard decisions to revitalise those and repurpose those assets, we should be encouraged to do it. I think the debt should be less when I refurbish than if I'm doing a new build. I think, to your point, Norman, the risks are less, but I think that should be priced in as well. If we've got a current NOI, and then we're building a business case if we're going to invest X, that customer logically is going to pay more because they're getting more in the future, then I think that's a considerably more attractive commercial packaging than here's a map, a piece of land, and here's a beautiful architect's drawing of what it's going to look like. So to the fundamental of how you package it, I think it's more appealing. And then we think from our side that we can de-risk it by, again, going back and looking at the asset, recycling. You know, if, for instance, there could be electronics in the building that are obsolete, don't just throw them away. Let's recycle that material and use that cash to reinvest in the asset. Look at the team. Maybe you close the asset for a period of time, not always ideal. You can retrain, you can develop. So in Casablanca, where we were forced to close Lotfi, we actually took the team on training. You know, we encouraged them to do new vocational skills. We removed the contract obligation saying they couldn't work for other people. And we tried to allow them to have a life-changing experience, knowing they could come back to work when we were ready to reopen the hotel. That's as important as changing the facade and the lobby experience of the hotel for us. So again, I think that where you look at the equity globally, it's saying it wants to invest in environmental, conscientious. They want to invest in social positive initiatives. Revitalising a hospitality business fits all those corners, so why shouldn't the cost of capital be less?
No, it's a very good point. And I mean, my perspective, and I'd be interested to hear yours, is that some of the older hotels, you know, the 40, 50-year-old ones that were built by governments initially, a lot of them are actually easier to refurb than some of the newer ones because they were built to the old brand standards, you know, from the 70s or whatever it is, 60s and 70s. So they have the big back of house areas, and it was all kind of built properly rather than some local developer throwing up a building for the sake of owning a hotel. I mean, I don't know what your view is on that.
Well, look at Intercontinental Nairobi, right? That to me is an iconic structure in the heart of one of the biggest cities in the continent. Exactly the same asset is in Lusaka, okay? Built with 360 keys.
Yep.
Now, nobody commercially can say there's enough demand in Lusaka to support 360 five-star rooms. And when you drill down, you'll find that those Intercontinental rooms are not very good. So working with Fidea, which is the sovereign wealth fund of Angola, Westmont partnered to then restructure that building. So it now has 106 all-suite Intercontinental rooms, and the other older, or the newer wing, if you like, the casino wing, if you know it from Nairobi, is a Holiday Inn. And that's allowed you to take what was seen as an exclusive 360-room complex and now turn it into a very accessible, family-friendly, $150 a night Holiday Inn. It's great quality. Next door to an en-suite, full suite, purpose-built Intercontinental with extensive meeting space. So that's us taking, to your point, a historical asset built in the 60s, and now I would argue making it the best asset in Sub-Sahara.
Yeah, so that's exactly my point. I'll stay away from government shareholders. But I think the light's going on as a bit of a sign that they wanted us to start wrapping up. So I don't know if any of you gents want to add anything, but otherwise I'll put it to the floor for any questions anybody might have. I don't know if we have a roaming mic or if anybody just wants to shout out. No questions for these guys? I think that's a lack of owners in the room. Awesome. I think that's us. Big red sign says time's up. I guess that's it. Thank you, everybody.
Thank you.
Thanks.
Thank you.
Thank you, Mark.